As trade increases and gives rise to a middle class of merchants, the economic power and sheer practicality of moneylending becomes apparent even to its harshest critics.
They see economic activity, they see the need for bankers, and this is where they start separating out the concept of interest from usury, and they start coming up with rationalizations to justify the religious dogma.
St. Thomas Aquinas in the Middle Ages allowed for a loophole, if you will, that said, I'm not supposed to charge you on a loan unless it costs me to lend you that money. So I'm losing the income I would have gotten with an investment. It's okay for me to charge you that.
To atone for the sin of making money from money, rich Italian bankers like the Medici commissioned countless devotional works dedicated to the glory of the church. Among the notable beneficiaries of these guilt offerings are some guys you may have heard of: Michelangelo, Botticelli, and Leonardo da Vinci. Okay, it's never easy, but after a few centuries marched with ignorance, boredom, wretchedness, and plague, Western man eventually finds a way to drag himself out of the Middle Ages. You see this? This is what kicks off the modern world. Right here. The Crusades give the Western world a taste of the Middle East and its riches. Afterward, Western traders return, carrying precious metals, wine, and wool to be exchanged for spices, linen, Egyptian paper, and perfume.
So there were these regional fairs that would occur around Europe. And so traders would come out of Italy or Spain or southern France, and they would bring whatever wares they brought with them. But they would trade their goods with each other, but they didn't want to carry a lot of money around because that's dangerous. I mean, lots of highway robbers on the road back in those days. So what they learned was to trade pieces of paper, which were known as bills of exchange, which was, I promise to pay you this amount at some future date at some distant location.
What you had was the great merchants, the great merchant bankers and money changers, developing their own form of private credit. This is just the liabilities of these merchants, which could then circulate amongst themselves as a private money.
Once you start trading paper securities, banking is a logical next step.
If you had gold and you were not rich enough to have a castle, you had to keep it somewhere. So you would go to a goldsmith and you would give the goldsmith your gold.
And the jeweler gives them a certificate, says you put 10 pounds of silver in my shop.
At some point, the goldsmith realized that people were using the receipts. Instead of actually using the gold, they would leave the gold with him and use the receipts as money.
And then the bankers say, wait a minute, I can print more of these things and lend this money out at interest and become rich as Croesus.
I just need to keep enough so that when people come in and actually want their gold back, I'll have gold to give them.
Fractional reserve banking is the ability that allows banks to create additional money. It's the heart of our whole economic system since the Industrial Revolution and before.
And just like that, banking is born. The goldsmiths, now bankers, borrow money in the form of deposits on which they pay interest. They then take that money and loan it out at a higher rate of interest.
Lending money is practical. It makes sense. It's helpful. It's productive, not just to the lender who's going to make a profit on it, but also for the borrower.
If I'm going to build a manufacturing plant, I'm not likely to have all the capital I need to build that plant. I can borrow it from a bank, and I can build a manufacturing plant that creates jobs and improves the standard of living.
I can now buy a house that I can't afford if I have to pay cash. I can live in a big house for 30 years and pay it off over those 30 years. If I buy the house with cash, it would take me 30 years to buy this house, and I'd have almost no life left to enjoy it.
Banking is an incredibly valuable economic activity. It's because what banks do is allocate capital rationally. They make sure that our resources are used very productively.
I mean, that's how we got Gutenberg and his printing press, Edison and his light bulbs, Jobs and his computer, and this guy. With the increase in trade and commerce in the late Middle Ages, funded by me,
you're welcome.
You get the rise of the powerful nation-states. But for cash-strapped sovereigns, building an empire in the early modern world is a pricey enterprise.
Governments certainly need financiers when they're incurring big debts, when they're fighting wars especially. And they've had two traditional means. One is using their control of the mint to debase the currency, and the other is to tap into the banking system.
Banks have always loaned money to rulers, mostly because they don't have a choice. Most of the great medieval banks of Europe, including the Medici, eventually closed as a direct result of sovereigns reneging on loans.
And so bankers, they would loan royalty money, but it would be at a very high rate of interest to make up for that risk.
Sovereigns would abuse this monetary standard in their own interests. All of a sudden, it would be announced that the coins in their pocket were not worth £1, they were only worth, 10 shillings or something.
Look, there is always taxation, but then you get a disgruntled populace and people burning you in effigy and similar unpleasantness. More and more, a bank loan seems like the way to go, provided, of course, that one can make a deal. The Glorious Revolution of 1688 sends the Catholic King of England packing and sees Parliament import a more finance-friendly monarch in William III from Protestant Holland. This sets the stage for the establishment of the Bank of England in 1694, the world's first central bank.
The Bank of England is a joint stock limited liability company. It issues shares to mostly held by very wealthy people.
The Bank of England, okay, the first sort of limited liability bank in the world. It was set up to help the government actually fund its and essentially repay its debt, refinance its debt.
Governments didn't invent banks, but they became cozy with bankers because it was a way to finance their own undertakings cheaply. And they created privileged banks, and as a quid pro quo, those banks were understood that they were under the obligation to lend to the government.
There's an inherent conflict of interest between a government that is borrowing from a bank and also regulating a bank. And a bank that relies on government help and is also lending to government. But as some would say, where there's no conflict, there's no interest.
In time, as governments grow and become more powerful, they find that banks have other uses.
The requirements of governments grew beyond the need simply for finance. They had to create public order. One way to do that, of course, is the police, but a far more effective way to do that is to align everybody's incentives in the society with maintaining whatever social order currently exists. Banks therefore became a vehicle to maintain order by channeling credit to particular groups.
You might say this marks the beginning of cronyism as we've come to know it. This special relationship between government and the financial sector will remain in place for the next 7 or 8 centuries, all the way up until, what time is it? By the 18th century, people realized that the key ingredient to success in the modern world is capital, value not seized through warfare, but created through loans and investments in productive and profitable ventures.
Why did we suddenly get a massive explosion of economic growth in Northern Europe and in North America just a few hundred years ago? For tens of thousands of years, we made essentially no economic progress. But then suddenly, a few hundred years ago, somebody flicked a switch and economic growth started.
A pivotal moment in human history was coming to grips with the idea of progress. The idea that investing $1 today could be $1.10 in a year from now. We start to get the idea of investment, that money can grow, and that borrowing money to invest it can be productive.
Once you established a vibrant banking system that could create credit, then you could fund a venture without being wealthy. If you had a viable idea, and you could then go to the bankers that could create the money to fund it, then suddenly that viable idea could be implemented.
It's also clear that capital markets work most efficiently and best in places where property rights and the rule of law are strongest.
More important than the wheel, more important than fire, it was the invention of the rule of law, of individual rights, of free markets. All business, economic activity depends on rule of law. It depends on there being some legal authority to enforce contracts.
For the first time in history, individuals, as in anybody, have an opportunity to live life according to their own plan. At least, that's the idea. And then, of course, there's our old friend, the 800-pound gorilla lurking just around the corner, the powers that be. Independent-minded colonists come to America looking for freedom and a new beginning. But they also come with old world baggage, an unhealthy distrust of bankers. The new nation has no independent banking system, no common currency, not even the power to levy taxes to reduce the debt. But the Constitution doesn't provide for a federally created central bank. And besides, having just thrown over their colonial masters, the young nation is not inclined to place its trust in centralized anything.
Americans in particular are very suspicious of moneyed interests and centralized power.
The bank structure in the United States really was as it was and still is today because of the fear of aggregation of financial power in the hands of few, all right? That led them to many, many small banks. And then also the principle of state control as opposed to federal control.
In the United States, we made 3 attempts to have a central bank, and those attempts failed because people thought the government would have too much authority, and they didn't want the bankers messing with our lives.
America at this point is a nation of farmers, and they prefer to keep their financial institutions small, independent, and close to home.
People didn't want banks to branch.
The big issue was that if that local bank had been able to set up branches elsewhere, that means that other banks were able to come into this town and establish branches and drive the local banks out of business. I don't like that because I don't want to deal with some far-off banker in Chicago or New York that couldn't care less about my town and my business.
For most of the United States in the 1800s, it was illegal for a bank to have more than one location.
This inability to branch and diversify makes standalone unit banks a risky enterprise. Because being tied to one region, you can't diversify risk.
The more you let banks grow and diversify, the less risky they are because they're not putting all of their eggs in one basket.
If crops fail in one region, you fail along with them.
In the 19th, early 20th century, the U.S. was alone in its extreme instability. And everybody knew it, and everybody knew what caused it. What caused it was a politically determined predisposition for a fragmented banking system.
If you look north of the border in Canada, where they didn't have those restrictions, there are no money panics.
Throughout the 19th century, politically motivated restrictions on branch banking contribute to a banking crisis in almost every decade, for which bankers are naturally blamed. This is a dilemma shared by no other developed country.
The banking system was fragmented, chaotic, undiversified, you might say, Looney Tunes.